Part 3. From Hoover to Roosevelt. The Federal Reserve and the Financial Elites. This chapter is grounded on the insight that American politics, from the turn of the 20th century until World War II, can far better be comprehended by studying the interrelationship of major financial groupings than by studying the superficial and often sham struggles between Democrats and Republicans. In particular, American politics in this period was marked by a fierce struggle between two major financial industrial groupings. The interests clustered around the House of Morgan on the one hand, and an alliance of Rockefeller, oil, Harriman, railroad, and Kuhn-Leb, investment banking, interests on the other. The Morgans began in investment banking and moved out into railroads, commercial banking, and then manufacturing. The Rockefeller, Harriman, Kuhn-Leb alliance began in their three respective original spheres and moved into commercial banking. In most instances, the two mighty combines clashed, for example, in whether or not Theodore Roosevelt, always closely allied to the Morgans, should use the antitrust weapon to smash Standard Oil, or whether, in his turn, President Taft, allied with the Ohio-based Rockefellers, should try to break up Morgan trusts such as International Harvester or United States Steel. In other areas, the interests of the two mammoths coincided, and they were allies. Thus, both groups were heavily represented in the drive for measures cartelizing industry that were sought and lobbied for by the National Civic Federation during the Progressive Era, and both groups joined to push through the Federal Reserve System. The Early Fed, 1914 to 1928, the Morgan years. In their joining together to draft and then to lobby for the new Federal Reserve System, the House of Morgan was clearly very much the senior partner in the enterprise. The secret meeting of a handful of top bankers at the Jekyll Island Club in November 1910 that framed the prototype for the Federal Reserve Act was held at a resort facility provided by J.P. Morgan himself. The Federal Reserve, in its first 2 decades, contained two loci of power. The main one was the head, then called the governor, of the Federal Reserve Bank of New York. Of lesser importance was the Federal Reserve Board in Washington. The governor of the New York Fed, from the beginning until his death in 1928, was Benjamin Strong, who had spent his entire working life in the Morgan ambit. He was a vice president of the Bankers Trust Company, established by the Morgans to engage in the new and lucrative trust business, and his best friends in the world were his mentor and neighbor, the powerful Morgan partner Henry P. Davison, as well as 2 other Morgan partners, Dwight Morrow and Thomas W. Lamont. So highly trusted was Strong in the Morgan circle that he was brought in to be the personal auditor of J. Pierpont Morgan, Sr. during the Panic of 1907. When he was offered the post of governor of the New York Fed in the new Federal Reserve System, the reluctant Strong was convinced by Davison that he could operate the Fed as a, quote, real central bank, run from New York, end quote. The Morgans were not nearly as dominant in the then lesser institution of the Federal Reserve Board in Washington. On the original board, there were 7 members, of whom 2, the Secretary of the Treasury and the Comptroller of the Currency, were ex officio. The Morgan bloc on the original board was led by Secretary of the Treasury William Gibbs McAdoo, son-in-law of President Wilson, whose Hudson and Manhattan Railroad Company in New York had been bailed out personally by J.P. Morgan, who then proceeded to staff the officers and board of Hudson and Manhattan with his closest business associates. From that point on, McAdoo was surrounded by a Morgan ambiance. Comptroller of the Currency was John Skelton Williams, a protege of McAdoo's who had also been a director of the Hudson and Manhattan Railroad. Another board member was McAdoo protege Charles S. Hamlin, who came to the board from the post of Assistant Secretary of the Treasury. In addition to being a wealthy Boston lawyer, from a Boston financial group long affiliated with the Morgan interests, Hamlin had married into the wealthy Pruin family of Albany, which had been associated with the Morgan-dominated New York Central Railroad. If these 3 were solid Morgan men, the other 4 Reserve Board members were not nearly as reliable. Paul M. Warburg was partner and brother-in-law of Jacob Schiff of the investment banking house of Kuhn-Leb. Frederick A. Delano, uncle of Franklin D. Roosevelt, was president of the Rockefeller-controlled Wabash Railway. William P.G. Harding was an Alabama banker whose father-in-law's iron manufacturing company had prominent Morgan as well as rival Rockefeller men on its board. And Adolph C. Miller was an academic economist at Berkeley who had married into the wealthy Morgan-connected Sprague family of Chicago. Thus, of the 7 members of the original board, 3 were Morgan men, but of whom 2 were ex officio. 1 was Kuhn Leb, 1 Rockefeller, 1 an independent banker with both Morgan and Rockefeller connections, and 1 was an economist with vague family ties to the Morgans. Hardly complete Morgan control of the board. But the Morgans not only had by far the most powerful Federal Reserve banker, Benjamin Strong, in their corner, they also had the Republican administrations of the 1920s. Although there were various groups around President Warren G. Harding, as an Ohio Republican, he was closest to the Rockefellers, and as Secretary of State, Charles Evans Hughes was a mentor of John D. Rockefeller Jr.'s New York Bible class, a leading Standard Oil attorney, and a trustee of the Rockefeller Foundation. Harding's sudden death in August 1923, however, unexpectedly elevated Vice President Calvin Coolidge to the presidency. Coolidge had been misleadingly described as a colorless, small-town Massachusetts attorney. Actually, the new president was a member of a prominent Boston financial family, who were board members of leading Boston banks. One, T. Jefferson Coolidge, became prominent in the Morgan-affiliated United Fruit Company of Boston. Throughout his political career, moreover, Calvin Coolidge had 2 important mentors, both neglected by historians. One was Massachusetts Republican Party Chairman W. Murray Crane, who served as a director of 3 powerful Morgan-dominated institutions, the New Haven and Hartford Railroad, the Guarantee Trust Company of New York, and AT&T, on which he was also a member of the board's executive committee. The other was Amherst classmate and prominent Morgan partner Dwight Morrow. Morrow began to agitate for Coolidge for president as early as 1919, and continued his pressure at the Chicago Republican Convention of 1920. Dwight Morrow and fellow Morgan partner Thomas Cochran lobbied strenuously for Coolidge at Chicago. Cochran, who was not an Amherst graduate, did not have the Amherst excuse for working for Coolidge, and so he kept in the background. Cochran and Morrow were happy, as prominent Morgan men, to confine their work to the background and to push forward as their frontman for Coolidge the large, doughty Boston merchant Frank Stearns, who did have the virtue of being an Amherst graduate. Secretary of the Treasury throughout all 3 Republican administrations of the 1920s was the powerful, multimillionaire tycoon Andrew Mellon, head of the Mellon interests, whose empire spread from the Mellon National Bank of Pittsburgh to encompass Gulf Oil, Koppers Company, and Aluminum Corporation of America. Mellon was generally allied to the Morgan interests. Furthermore, when Charles Evans Hughes returned to private law practice in the spring of 1925, Coolidge offered his crucial State Department post to longtime Wall Street attorney and former Secretary of State and of War, Elihu Root, who might be called the veteran head of the, quote, Morgan Bar. At one critical time in Morgan's affairs, Root had served as Morgan's personal attorney. After Root refused the State Department post, Coolidge was forced to settle for a lesser Morgan light, Minnesota attorney Frank B. Kellogg. Undersecretary to Kellogg was Joseph C. Grew, who had family connections with the Morgans. J.P. Morgan Jr. had married a Grew, while, in 1927, 2 highly placed Morgan men were asked to take over relations with troubled Mexico and Nicaragua. The year 1924 indeed saw the House of Morgan at the pinnacle of political power in the United States. President Calvin Coolidge, friend and protege of Morgan partner Dwight Morrow, was deeply admired by J.P., quote, Jack Morgan Jr. Jack Morgan saw the president, perhaps uniquely, as a rare blend of deep thinker and moralist. Morgan wrote a friend, quote, I have never seen any president who gives me just the feeling of confidence in the country and its institutions, and the working out of our problems that Mr. Coolidge does. End quote. On the other hand, the House of Morgan faced the happy dilemma in the 1924 presidential election that the Democratic candidate was none other than John W. Davis, senior partner of the Wall Street firm of Davis, Polk, and Wardwell, and chief attorney for J.P. Morgan and Company. Davis, a protege of the legendary Morgan partner Henry Davison, was also a personal friend and a backgammon and cribbage partner of Jack Morgan's. It was an embarrassment of riches. Whoever won the 1924 election, the Morgans could not lose, although they decided to opt for Coolidge. However, 1928 saw inevitable changes in Morgan domination of monetary policy. Benjamin Strong, sickly all year, died in October, and was replaced by George L. Harrison, his hand-picked successor. While Harrison was a devoted, quote, Morgan loyalist, he did not quite carry the clout of Benjamin Strong. The Coolidge administration, too, was coming to an end. The Morgans, again facing an embarrassment of riches, were torn three ways. Their prime goal was to induce their beloved president to break precedent and run for a third term. Not being able to persuade Coolidge, the Morgans next turned to Vice President Charles G. Dawes, who had been connected with various Morgan railroads in Chicago. When Dawes dropped out of the race, the Morgans turned at last to Herbert Clark Hoover, who had been a powerful Secretary of Commerce during the two Republican administrations of the 1920s. While Hoover had not been as intimately connected with the Morgans as had Calvin Coolidge, he had long been close to the Morgan interests. Particularly influential over Hoover during his administration were two unofficial but powerful advisors, both Morgan partners, Thomas W. Lamont and Dwight Morrow, whom Hoover consulted regularly 3 times a week. Herbert Hoover's cabinet was also loaded with Morgan people. As Secretary of State, Hoover chose the longtime Morgan lawyer and disciple and partner of Elihu Root, Henry L. Stimson. Andrew Mellon continued as Treasury Secretary, and his undersecretary, who was to replace Mellon in 1931 and was close to Hoover, was Ogden L. Mills, a former congressman and New York corporate lawyer whose father, Ogden L. Mills Sr., had been a leader of such Morgan railroads as New York Central. Hoover's Secretary of the Navy was Charles Francis Adams III, from the famous Boston Brahmin family, long associated with the Morgans. This particular Adams' daughter had been fortunate enough to marry Jack Morgan. Benjamin Strong's monetary policy, throughout his reign, was essentially a Morgan policy. The Morgans, through their subsidiary, Morgan Grenfell, in London, had long been intimately associated with the British government and with the Bank of England. Before World War I, the House of Morgan had been named a fiscal agent of the British Treasury and of the Bank of England. After the war began, the Morgans became the sole purchaser of all goods and supplies for the British and French war effort in the United States, as well as the monopoly underwriter in the United States of all British and French bonds. The Morgans played a substantial role in bringing the United States into the war on Britain's side, and, as head of the Fed, Benjamin Strong obligingly doubled the money supply to finance America's role in the war effort. After the end of the war, Strong's monetary policy was deliberately guided by the prime objective of helping Great Britain establish and impose upon Europe a new and disastrous gold exchange standard. The idea was to restore, quote, England, which really meant the Morgans, English associates and allies, to her old position of financial dominance by helping her establish a phony gold standard. Ostensibly, this was a return to the pre-war, quote, classical gold standard. But the return, in the spring of 1925, was at the pre-war par, a rate that hopelessly overvalued the pound sterling, which Britain had inflated and depreciated during the fiat money era after 1914. Britain insisted on returning to gold at an overvalued par, a policy guaranteed to hobble British exports, and yet was determined to indulge in continued cheap money and inflation instead of contracting its money supply to make the pre-war par viable. To help Britain get away with this peculiar and contradictory policy, the United States helped to pretend that the post-1925 standard in Europe, this gold bullion pound standard, was really a genuine gold coin standard. The United States inflated its money and credit in order to prevent inflationary Britain from losing gold to the United States, a loss which would endanger the new, jerry-built, quote, gold standard structure. The result, however, was eventual collapse of money and credit in the U.S. and abroad, and a worldwide depression. Benjamin Strong was the Morgan's architect of a disastrous policy of inflationary boom that led, inevitably, to bust. The Hoover Fed, Harrison and Young. While Secretary of Commerce, Herbert Hoover had been a severe critic of Strong's inflationary policies. Unfortunately, however, Hoover was in favor of a different form of easy money and cheap credit. When he became president, he tried, like King Canute, to hold back the tides by continuing to generate cheap bank credit, and then using, quote, moral suasion to exhort banks and other lenders not to lend money for the purchase of stock. Hoover suffered from the fallacious view that industrial credit was productive and, quote, legitimate, while financial, stock market credit was, quote, unproductive. Moreover, he believed that valuable capital funds somehow got lost or, quote, absorbed in the stock market and therefore became lost to productive credit. Hoover employed methods of intimidation of business that had been honed when he was food czar in World War I and then Secretary of Commerce, now trying to get banks to restrain stock market loans and to induce the New York Stock Exchange to curb speculation. Roy Young, Hoover's new appointee as governor of the Federal Reserve Board, suffered from the same fallacious view. Partly responsible for the Hoover administration's adopting this policy was the wily manipulator Montague Norman, head of the Bank of England and close friend of the late Benjamin Strong, who had persuaded Strong to inflate credit in order to help England's disastrous gold exchange policy. Norman, it might be added, was very close to the Morgan Grenfell Bank. By June 1929, it was clear that the absurd policy of moral suasion had failed. Seeing the handwriting on the wall, Norman switched and persuaded the Fed to resume its old policy of inflating reserves through subsidizing the acceptance market by purchasing all acceptances offered at a subsidized rate, a policy the Fed had abandoned in the spring of 1928. Despite this attempt to keep the boom going, however, the money supply in the United States leveled off by the end of 1928 and remained more or less constant from then on. This ending of the massive credit expansion boom made a recession inevitable, and sure enough, the American economy began to turn down in July 1929. Feverish attempts to keep the stock market boom going, however, managed to boost stock prices while the economic fundamentals were turning sour, leading to the famous stock market crash of October 24th. This crash was an event for which Herbert Hoover was ready. For a decade, Herbert Hoover had urged that the United States break its age-old policy of not intervening in cyclical recessions. During the post-war 1920 to 1921 recession, Hoover, as Secretary of Commerce, had unsuccessfully urged President Harding to intervene massively in the recession, to, quote, do something to cure the depression, in particular to expand credit and to engage in a massive public works program. Although the United States got out of the recession on its own, without massive intervention, Hoover vowed that next time it would be different. In late 1928, after he was elected president, Hoover presented a public works scheme, the, quote, Hoover Plan, for, quote, permanent prosperity, for a pact to, quote, outlaw depression to the Conference of Governors. Hoover had adopted the scheme of the well-known inflationists Foster and Catchings for a mammoth $3 billion public works plan to, quote, stabilize business cycles. William T. Foster was the theoretician, and Waddell Catchings the financier of the duo. Foster was installed as head of the Pollock Foundation for Economic Research by Catchings, iron and steel magnate and investment banker at the powerful Wall Street firm of Goldman Sachs. When the stock market crash came in October 1929, therefore, President Hoover was ready for massive intervention to attempt to raise wage rates, expand credit, and embark on public works. Hoover himself recalls that he was the very first president to consider himself responsible for economic prosperity. Quote, therefore, we had to pioneer a new field, end quote. Hoover's admiring biographers correctly state that, quote, President Hoover was the first president in our history to offer federal leadership in mobilizing the economic resources of the people, end quote. Hoover recalls it was a, quote, program unparalleled in the history of depressions, end quote. The major opponent of this new status dogma was Secretary of the Treasury Mellon, who, though one of the leaders in pushing the boom, now at least saw the importance of liquidating the malinvestments, inflated costs, prices, and wage rates of the inflationary boom. Mellon, indeed, correctly cited the successful application of such laissez-faire policy in previous recessions and crises. But Hoover overrode Mellon with the support of Treasury Undersecretary Ogden Mills. If Hoover stood ready to impose an expansionist and interventionist New Deal, Morgan man George L. Harrison, head of the New York Fed and major power in the Federal Reserve, was all the more ready to inflate. During the week of the crash, the last week of October, the Fed doubled its holdings of government securities, adding $150 million to bank reserves, as well as discounting $200 million more from member banks. The idea was to prevent liquidation for the bloated stock market, and to permit the New York City banks to take over the loans to stockbrokers that the non-lenders were liquidating. As a result, member banks of the Federal Reserve expanded their deposits by $1.8 billion, a phenomenal monetary expansion of nearly 10% in 1 week. Of this increase, $1.6 billion were increased deposits of the New York City banks. In addition, Harrison drove down interest rates, lowering its discount rates to banks from 6% to 4.5% in a few weeks. Harrison conducted these actions with a will, overriding the objections of Federal Reserve Board Governor Roy Young, proclaiming that, quote, the stock exchange should stay open at all costs, end quote, and announcing, quote, gentlemen, I am ready to provide all the reserve funds that may be needed, end quote. By mid-November, the great stock break was over, and the market, artificially buoyed and stimulated by expanding credit, began to move upward again. With the stock market emergency seemingly over, bank reserves were allowed to decline, by the end of November, by about $275 million, to just about the level before the crash. By the end of the year, total bank reserves at $2.35 billion were almost exactly the same as they had been the day before the crash, or at the end of November, with total bank deposits increasing slightly during this period. But while the aggregates of factors determining reserves were the same, their distribution was very different. Fed ownership of government securities had increased by $375 million during these 2 months, from the level of $136 million before the crash, but the expansion had been offset by lower bank loans from the Fed, by greater money in circulation, and by people drawing $100 million of gold out of the banking system. In short, the Fed tried its best to inflate a great deal more, but its expansionary policy was partially thwarted by increasing caution and by withdrawal of money from the banking system by the general public. Here we see, at the very beginning of the Hoover era, the spuriousness of the monetarist legend that the Federal Reserve was responsible for the great contraction of money from 1929 to 1933. On the contrary, the Fed and the administration tried their best to inflate, efforts foiled by the good sense and by the increasing distrust of the banking system of the American people. At any rate, even though the Fed had not managed to inflate the money supply further, President Hoover was proud of his experiment in cheap money and of the Fed's massive open market purchases. In a speech to a conference of industrial leaders he had called together in Washington on December 5th, the president hailed the nation's good fortune in possessing the splendid Federal Reserve System, which had succeeded in saving shaky banks, restoring confidence, and making capital more abundant by lowering interest rates. Hoover had personally done his part by urging banks to discount more at the Fed, while Secretary Mellon reverted to his old Pollyanna mode in assuring one and all that there was, quote, plenty of credit available. Hoover admirer William Green, head of the American Federation of Labor, proclaimed that the, quote, Federal Reserve System is operating, serving as a barrier against financial demoralization. Within a few months, industrial conditions will become normal. Confidence and stabilization in industry and finance will be restored. End quote. By the end of 1929, Roy Young and other Fed officials favored pursuing a laissez-faire policy, quote, to let the money market sweat it out and reach monetary ease by the wholesome process of liquidation, end quote. Once again, however, Harrison and the New York Fed overruled Washington and instituted a massive easy money program. Discount rates of the New York Fed fell from 4.5% in February to 2% at the end of 1930. Other short-term interest rates fell similarly. Once again, the New York Fed led the inflationist parade by purchasing $218 million of government securities during the year. The resulting increase of $116 million in bank reserves, however, was offset by bank failures in the latter part of the year, and by enforced contraction on the part of the shaky banks remaining in business. As a result, total money supply remained constant throughout 1930. Expansion was also cut short by the fact that the stock market boomlet early in the year had collapsed by the spring. During the year, however, Montague Norman was able to achieve part of his long-standing wish for formal collaboration between the world's major central banks. Norman pushed through a new central bankers' bank, the Bank for International Settlements, or BIS, to meet regularly at Basel and to provide regular facilities for cooperation. While the suspicious Congress forbade the Fed from joining the BIS formally, the New York Fed and its allied Morgan interests were able to work closely with the new bank. The BIS, indeed, treated the New York Fed as if it were the central bank of the United States. Gates W. McGarrah resigned as chairman of the board of the New York Fed in February to assume the position of president of the BIS, while Jackson E. Reynolds, a director of the New York Fed particularly close to the Morgan interests, became chairman of the BIS's organizing committee. Unsurprisingly, J.P. Morgan and Company supplied much of the capital for the new BIS. And even though there was no legislative sanction for U.S. participation in the bank, New York Fed Governor George Harrison made a, quote, regular business trip abroad in the fall to confer with the other central bankers, and the New York Fed extended loans to the BIS during 1931. Late 1930 was perhaps the last stand of the laissez-faire, sound money liquidationists. Professor H. Parker Willis, a tireless critic of the Fed's inflationism and credit expansion, attacked the current easy money policy of the Fed in an editorial in the New York Journal of Commerce. Willis pointed out that the Fed's easy money policy was actually bringing about the rash of bank failures because of the bank's, quote, inability to liquidate their unsound loans and assets. Willis noted that the country was suffering from frozen, wasteful malinvestments in plants, buildings, and other capital, and maintained that the Depression could only be cured when these unsound credit positions were allowed to liquidate. Similarly, Albert Wiggin, head of the Chase National Bank, clearly reflecting the courageous and uncompromising views of the Chase Bank's chief economist, Dr. Benjamin M. Anderson, denounced the Hoover policy of propping up wage rates and prices in depressions and of pursuing inflationary cheap money, saying, quote, our depression has been prolonged and not alleviated by delay in making necessary readjustments, end quote. On the other hand, Business Week, then as now a spokesman for, quote, enlightened business opinion, thundered in late October 1930 that the, quote, deflationists were, quote, in the saddle. In August 1930, however, President Hoover took another decisive step in favor of inflationism by replacing Roy Young as chairman of the Federal Reserve Board by the veteran speculator and government official Eugene Meyer, Jr. The advent of Eugene Meyer, Jr. Eugene Meyer, Jr. differed from Strong and Harrison in not being totally in the Morgan camp. Meyer's father, an immigrant from France, had spent all his life in the employ of the French international banking house of Lazard Frères, finally rising to the post of partner of Lazard's New York branch. Eugene Jr. early broke out from Lazard on his own and became a successful speculator, investor, and financier, an associate of the Morgans, and even more closely an associate of Bernard Baruch and Baruch's patrons, the powerful Guggenheim family, in virtual control of the American copper industry. It is true, however, that Meyer's brother-in-law, George Blumenthal, had left this post at Lazard to be a high official in J.P. Morgan and Company, and that Meyer himself had once acted as a liaison between the Morgans and the French government. By the 1920s, Meyer's major financial base was his control of the mighty integrated chemical firm Allied Chemical and Dye Corporation. Before World War I, Meyer's major financial involvement had been with the Guggenheims and the copper industry. By 1910, he was so prominent in the copper industry that he was able to arrange a cartel agreement between his old patrons, the Guggenheims and Anaconda Copper, each agreeing to cut its production by 7.5%. In the same year, Meyer discovered in London a highly productive and profitable new process for mining copper, and was quickly able to become its franchisor in the United States. It should not be surprising, then, that, under the regime of World War I collectivism, Meyer began, first in early 1917, as head of the non-ferrous metals unit of Bernard Baruch's Raw Materials Committee under the Advisory Commission of the Council of National Defense. The non-ferrous metals unit included copper, lead, zinc, antimony, aluminum, nickel, and silver. When the War Industries Board took over the task of collectivist planning of industry in August 1917, Meyer assumed the same task there, and was also to become the virtual, quote, czar of the copper industry. More important for his eventual role in the Hoover administration was Meyer's crucial part in the War Finance Corporation, or WFC. The WFC had been set up by Secretary of the Treasury McAdoo in May 1918, ostensibly to finance industries essential to the war effort. Meyer was named the WFC's managing director. The WFC massively subsidized American industry. During the war, it had two basic functions. One was acting as agent of the Treasury to prop up the market for U.S. government bonds. During the last 6 months of the war, Meyer spent $378 million to keep government bonds from falling by more than 1/4 point a day, and later resold the bonds to the Treasury at the cost of purchase. The second and dominant function of the WFC was to subsidize and bail out firms and industries in trouble, allegedly, quote, essential to the war effort. The WFC began with an authorized capital of $500 million supplied by the Treasury, and with the power to borrow up to $3 billion through the issue of bonds. Its major focus was on utilities, railroads, and the banks that had financed them. Banks were also under strain because many of their savings deposits had been drawn down to help finance the federal deficit. All in all, during the war, the WFC made loans of $71 million in addition to its bond price operations. It was clear that the essential mission of the WFC acted as a camouflage for a government subsidy operation. As Meyer's approving biographer writes, quote, the WFC had been created as a rescue mission for essential war-disrupted industries, and Meyer had shaped it into a powerful instrument of public policy. End quote. If the WFC, and for that matter the rest of the apparatus of war collectivism, had been strictly war-related, they all would have been dropped swiftly as soon as the armistice was signed on November 11th, 1918. But, on the contrary, Baruch, Meyer, the War Industries Board, and most business leaders were anxious to continue the benefits of collectivism indefinitely after the war was over. The goals were twofold: price controls to keep prices up during the expected post-war recession, and a permanent peacetime cartelization of American industry enforced by the federal government. Permanent cartelization was endorsed by the U.S. Chamber of Commerce and by the National Association of Manufacturers. President Wilson, however, prompted by Secretary of War Newton D. Baker, insisted on scuttling the WIB by the end of 1918. Other aspects of wartime government interventionism continued on, however, not the least of which was the War Finance Corporation. The War Finance Corporation was a striking example of a wartime government agency that refused to die. After the war, the investment bankers were worried that Europeans, shorn of American aid, would no longer be able to keep up the bountiful, wartime level of American exports. Hence, the Morgans urged their friends in the Treasury Department to use the WFC to provide credits to finance American exports, specifically to pay American exporters and then collect the money from foreign importers. While the Wilson administration did not want a permanent government loan program, it persuaded Congress to extend the WFC in March 1919 and to authorize it to lend up to $1 billion over 5 years to American exporters and to American banks that made export loans. Particularly ardent in pressuring Congress was WFC head Eugene Meyer, who had been gravely disappointed when the Wilson administration scuttled the War Industries Board. Meyer happily plunged into making and encouraging export loans and, while in Europe for the peace conference, he tried unsuccessfully to pressure British banks into issuing $600 million in loans to finance British imports and to keep the overvalued pound from falling to its market levels. To counter the dangerously inflationary post-war boom, President Wilson shifted David F. Houston from the post of Agriculture Secretary to Treasury Secretary, and Houston boldly set about shifting America to a more laissez-faire and deflationary course. Meyer worked feverishly to keep the inflationary boom going, the WFC approving loans totaling $150 million to finance the exports of cotton, tobacco, copper, coal, and steel. But Treasury Secretary Houston refused to give Meyer his required approval. Houston declared, in fact, that he was proposing ending the WFC in order to complete the government's withdrawal from all its wartime activities of government intervention in the economy. Houston pointed out that exports had already attained an unprecedented volume in 1919, and that it was important to bring down inflation. Meyer tried every device to persuade Houston, but he couldn't go over his head to the president because of Wilson's illness. Finally, Meyer threw in the towel and resigned his post in May 1920. Unfortunately, however, Eugene Meyer was soon back in the saddle. Recession always follows an inflationary boom. A recession hit in the fall of 1921, and the newly burgeoning farm bloc began its long-term drive to get the government to bring the farmer back to the unprecedented good times he had enjoyed from the artificial export boom created by World War I. During the presidential campaign of 1920, Secretary of Treasury Houston bravely resisted the farm bloc, maintaining that the federal government should do nothing to interfere with the inevitable post-war recession. Eugene Meyer, working for the Harding ticket, put himself at the head of the interventionist forces battling his old laissez-faire enemy. When Houston addressed the annual meeting of the American Bankers Association, or ABA, in Washington, he refused to speak if the ABA succumbed to pressure by a group of Memphis bankers and businessmen to have Meyer address the group at the same meeting. When Houston's ploy was successful, the Memphis group of inflationist and interventionist bankers organized a rump meeting nearby featuring the address by Meyer, who led a fervent campaign for restoration of the WFC, this time stressing government financing of agricultural exports. The defeat of the Democrats in November was a referendum on World War I, its aftermath, and the inflation and rationing of wartime, rather than against Houston, but Meyer used the victory to step up attacks on Secretary Houston. Organizing a nationwide campaign of demagoguery, stressing especially the plight of the cotton farmer, Meyer personalized his assault on Houston's stalwart, laissez-faire views. Combining hyperbole with alliteration, Meyer roasted Houston before the Joint Agricultural Committee of Congress. Meyer thundered, quote, "History records no precedent for the wholesale sacrifices imposed upon the civilized world by the Secretary's, Houston's, present policies for the purpose of maintaining the petty platitudes of the outworn political economy which he professes." End quote. Congress duly passed the measure to revive the export lending of the WFC. When Wilson followed Houston's advice to veto the measure, asking Houston himself to write the veto message in December, Congress easily overrode the veto. During the interregnum, Meyer and his friends angled for top jobs for him with the new Harding administration. But with Treasury and Commerce closed off, Meyer turned down the post of Assistant Secretary of Commerce under Herbert Hoover, correctly expecting Congress to reenact the WFC. The new president duly appointed Meyer to be head of the revived WFC, refurbished as an agricultural export aid bureau. In fact, exports were largely forgotten as the WFC was transformed into a simple agricultural relief agency. Under Meyer's aegis, and supported by Harding, Congress passed the Agricultural Credits Act of 1921, which increased the maximum authorized credits by the War Finance Corporation to $1 billion, and permitted it to lend directly to farmers, cooperatives, and foreign importers, as well as exporters. Meyer plunged in with a will, heavily financing farm co-ops, enabling them to buy and store crops, thereby raising farm prices, and presaging the more directly governmental farm price support policies of the Hoover and Roosevelt administrations. The WFC's first loan was to Aaron Shapiro's Staple Cotton Cooperative Association. Shapiro was a high-priced young attorney for several California farm co-ops who concocted grandiose plans for voluntary price-rising cartels in cotton, wheat, tobacco, and other crops, all of which turned out to be failures. By the summer of 1923, the WFC had loaned $172 million to farm co-ops and another $182 million to rural banks, which in turn loaned money to farmers. The WFC, working closely with farm bloc leaders, appointed a Corn Belt Advisory Committee of farm leaders to pressure Midwestern rural bankers into lending more heavily to farmers in that region. With banks providing a steady flow of short-term farm loans and a vast federal farm loan system established in July 1916, supplying plentiful mortgage loans, the farm bloc still felt a gap in unsubsidized intermediate-term credit. Meyer and the co-op interests duly introduced a bill into Congress calling for a system of privately capitalized agricultural credit corporations, with the Federal Reserve empowered to extend credits and support these corporations. But the farm bloc, supported by Secretary of Commerce Hoover and Secretary of Agriculture Henry C. Wallace, went further, backing a competing bill establishing a large, governmentally capitalized system of federal intermediate credit banks, patterned after the Federal Reserve System and governed by the Federal Farm Loan Board, or FFLB, which had already been established to run the farm loan system. Congress passed both bills in one Agricultural Credits Act of 1923 in the summer of that year. But the Meyer system was in effect a dead letter. How could a privately financed, albeit subsidized credit system compete with one financed by the U.S. Treasury? With WFC duties now assumed by the new Federal Intermediate Credit System, Eugene Meyer allowed the War Finance Corporation's authority to make loans expire at the end of 1924. The WFC lingered on with no duties for 5 years, until Congress finally liquidated it in 1929. Meyer was cheerful about its demise, however, because he was able to use the virtually defunct post to meddle in and eventually take over the now powerful Federal Farm Loan Board, or FFLB. Meyer assumed control of the FFLB in March 1927 and continued to run it until the advent of the Hoover administration 2 years later. His lengthy record in charge of inflationary government lending, in addition to his service in helping swing the New York Republican delegation to Hoover at the Republican Convention of 1928, made Eugene Meyer eminently qualified to be Hoover's new governor of the Federal Reserve Board in the autumn of 1930. Meyer in the Hoover administration. In the midst of a German and the American bank crises and a growing depression, Eugene Meyer battled the totally Morgan-run New York Fed for dominance over the Federal Reserve System. The Morgans were even more interested than Meyer in bailing out the European banking systems. In late June 1931, the New York Fed agreed to participate with the Bank of England, the Bank of France, and the Bank for International Settlements in a $100 million loan to try to bail out the German Reichsbank. Soon, the Germans were asking for $500 million more to save their banking system. While Harrison was sympathetic, Meyer and the other bankers felt this was too much of a long-term commitment. The German government then asked the Fed not only for the extra loan, but also for a reassuring statement, clearly mendacious, hailing the, quote, fundamental soundness of the German economy. Happening to be in New York in the midst of this German crisis on the weekend of July 12th, Meyer found out by accident of a secret meeting at the New York Fed on the crisis with the top Morgan people in the administration, including Morgan partners Russell Leffingwell and S. Parker Gilbert, Albert Wiggin, head of the Morgan-run Chase National Bank, acting Treasury Secretary Ogden Mills, Owen D. Young, chairman of the Morgan-run General Electric, and from the New York Fed, Governor George Harrison and Deputy Governor W. Randolph Burgess. The meeting had already persuaded President Hoover to issue a statement of sympathy for the German situation. Meyer, at this point, went ballistic, insisting that the president's statement, backed by a meeting of top banking worthies, would be taken by the Germans as well as everyone else as a, quote, moral commitment to help the Germans, end quote, which would either lead to a disastrous blank check support for German finance, or would make matters worse when that support was repudiated. Meyer also insisted that only the Federal Reserve Board in Washington could legally commit the Fed to such action. By his last-minute intervention, Meyer was fortunately able to block the Morgan cabal from getting Hoover to make the public endorsement. The following week, Hoover, aided by veteran Morgan-oriented lawyer and Secretary of State Henry L. Stimson, agitated again for direct loans to Germany, but Meyer was able to confine Hoover to engineering a Meyer-approved big power, quote, standstill agreement, by which banks throughout the major countries of the world would continue to hold German and other Central European short-term debts without trying to get out of German marks and other shaky currencies of that region. Generally, Meyer was able to overrule Harrison. Thus, when gold flowed out of U.S. banks after Britain's disastrous abandonment of the gold standard in late September, Meyer was able to force Harrison, wedded to cheap money, to raise the New York Fed's discount rate from 1.5% to 3.5% in October, thereby reversing the gold drain by raising market confidence in the dollar. By early September 1931, even before Britain's abandonment of the gold standard, President Hoover, Eugene Meyer, and the nation's financial establishment all agreed that America required a massive infusion of more money and credit under the direction of the federal government. There was one difference. Whereas Meyer and the bankers wanted a revival of the War Finance Corporation for government to pour in the new money directly, Hoover first wanted to try a dab of his characteristic government-business partnership to encourage private bankers to contribute the necessary hundreds of millions of dollars to a federal agency. Hoover set up his National Credit Corporation, or NCC, to attract $500 million from the banks in order to shore up shaky individual banks. But when the National Credit Corporation was only able to raise $150 million, Hoover quickly and cheerfully threw in the towel, and by the end of November, agreed to introduce a bill into Congress to revive the old WFC and expand it for peacetime uses into a new Reconstruction Finance Corporation, or RFC. The RFC bill, which sailed through Congress by late January 1932, provided for the Treasury to pour $500 million of capital into the Reconstruction Finance Corporation, which was empowered to issue securities up to an additional $1.5 billion. The RFC could make loans to banks and financial institutions of all types. The theory was that, ensured of freedom from failing, the timid banks would be emboldened to lend massively to business and industry, the money supply would dramatically rise, and prosperity would return. This was the doctrine trumpeted by President Hoover, Meyer, Mills, and Undersecretary of the Treasury Arthur A. Ballantine, a partner of the law firm headed by longtime Morgan attorney Elihu Root. Unsurprisingly, the representatives of groups expecting a massive infusion of federal money commercial banks, savings banks, life insurance companies, and building and loan, in later years, savings and loan associations, testifying before Congress, quote, all praised the RFC bill in glowing terms, claiming that it was essential to the survival of the money market, end quote. In addition, the RFC was empowered to lend money to railroads in order to relieve their indebtedness and revivify the railroad bond market. The railroad representatives were also delighted with the bill. Hoover's original bill was even more sweeping, also allowing the RFC to make business loans to, quote, bona fide institutions. But the Senate Democrats, suspicious of excessive executive power over business, killed this proposal. The Senate Democrats also reportedly extracted a promise from Hoover to make the beloved Eugene Meyer chairman of the new RFC. Meyer, doing double duty as governor of the Federal Reserve Board and head of the RFC, was now the most powerful single economic and financial force in the federal government. The RFC, at the Democrats' insistence, was to have a board of directors consisting of 4 Republicans and 3 Democrats. 3 of the Republicans were the ex officio heads of the Federal Reserve Board, Chairman Meyer, the Secretary of the Treasury, Ogden Mills, who had replaced Mellon in January, and of the Federal Farm Loan Board, Paul Bester, Meyer's protege and successor. The 4th Republican appointee was former Vice President Charles G. Dawes, a Chicago railroad man in the Morgan ambit. The RFC was not only patterned after the old War Finance Corporation in philosophy, but also aped its organizational structure and took over many of the WFC's actual personnel. The General Counsel and the 3 top examiners of the WFC happily took up their old posts, while the first secretary of the RFC was George Cooksey, a former director of the WFC who had been a member of that outfit's remarkably leisurely liquidation committee from 1929 until he assumed his new position in the RFC. Like the War Finance Corporation, the RFC established 8 divisions as well as 33 local loan agencies. Each of these loan agencies established an advisory committee consisting of the leading local bankers to scrutinize and pass on loan applications. This arrangement placed tremendous political and financial power into the hands of local bankers armed with federal power. Moreover, the Reconstruction Finance Corporation was not required to reveal the names of borrowers or the amounts of its loans to Congress or to the public. A tremendous political and economic power was thus placed in the RFC and bankers associated with it. Even progressive Senator George Norris of Nebraska lamented that he had never envisioned, quote, putting the government into business as far as this bill would put it, end quote. Hoover and his associates rationalized this power as being a temporary necessity to handle an emergency, supposedly much like World War I, when the prototype of the RFC had been established. Thus, Hoover repeatedly spoke of fighting the Depression as the equivalent of fighting a war. Quote, we are engaged in a fight upon 100 fronts, just as positive, just as definite, and requiring just as greatly the moral courage, the organized action, the unity of strength, and the sense of devotion in every community as in war. End quote. Eugene Meyer spoke repeatedly in military metaphors, and Secretary Mills spoke of the, quote, great war against depression being fought on many fronts, end quote. Especially the, quote, long battle to carry our financial structure through the worldwide collapse, end quote. And so too did business and financial leaders rationalize their hasty embrace of collectivism in the Reconstruction Finance Corporation. An illuminating article in the Magazine of Wall Street summarizing the congressional debate over the RFC bill noted that big business, quote, always complaining of public intervention in economic matters, end quote, was now beating the drums for intervention, the RFC being supported by big bankers, industrialists, and railroad presidents. The article added, quote, the answer made by representatives of business to the charge of socialism is that in all great emergencies, war, for example, governments have always thrown themselves into the breach, because only they can organize and mobilize the whole strength of the nation. In war, every country becomes practically a dictatorship, and every man's resources are at its command. The country is now in an equally great emergency." End quote. The RFC certainly paid off for these favored business groups. The excuse for the secrecy was that public confidence would be weakened if the identity of the shaky business or bank receiving RFC loans became widely known. But of course, these institutions, precisely because they were in weak and unsound shape, deserved to lose public confidence, and the sooner the better, both for the public and for the health of the economy, which required the rapid liquidation of unsound investments and institutions. During the first 5 months of operation, from February to June 1932, the RFC made $1 billion of loans, of which 60% went to banks and 25% to railroads. The theory was that railroad bonds must be protected, since many of these securities were held by savings banks and insurance companies, alleged agents of the small investor. In practice, the bulk of these RFC railroad loans went to repaying debt. About a third of these loans went to repaying railroad debts to banks. Thus, one of the first RFC loans was $5.75 million to the Missouri Pacific Railroad to repay its debt to J.P. Morgan and Company, and an $8 million loan to the B&O Railroad to repay its debt to Kuhn, Leb and Company. One of the main enthusiasts for this policy was Eugene Meyer, who touted it as, quote, promoting recovery by, quote, putting more money into the banks. It certainly did the latter, at the expense of the taxpayers and of propping up inefficient banks and businesses. The loan to Missouri Pacific was a particularly egregious case, for as soon as Missouri Pacific performed its task of repaying its debt to Morgan, it was gently allowed to go into bankruptcy. Another consequence of RFC bailout loans to railroads was to accelerate the socialization of the railroad industry, since the RFC, as a large-scale creditor, was able to place government directors on the board of the railroads reorganized after bankruptcy. While the Democrats in Congress had their way after August in forcing the RFC to report to Congress on its loans, President Hoover had his way in finally persuading Congress to transform the RFC into a bold, quote, positive agency empowered to make new loans, to engage in capital loans, to finance sales of agriculture at home and abroad, and to make loans to states and cities, instead of being merely an agency defending indebted banks and railroads. This amendment to the RFC Act, the Emergency Relief and Construction Act of 1932, passed Congress at the end of July and increased the RFC's authorized capital to $3.4 billion. Eugene Meyer, suffering from exhaustion, persuaded Hoover to include, in the amended bill, the separation of the ex officio members from the RFC. But Meyer's double-duty work was greatly appreciated by Felix Frankfurter, soon to be one of the major gurus of the Roosevelt New Deal. Frankfurter telegraphed Meyer's wife that, quote, Gene has been the only brave and effective leader in the Hoover administration in dealing with depression, end quote. Free market financial writer John T. Flynn had a very different assessment of the year of the Hoover-Meyer Reconstruction Finance Corporation. Flynn pointed out that RFC loans only prolonged the depression by maintaining the level of debt. Income, quote, must be freed for purchasing by the extinguishment of excessive debts. Any attempt to save the weaker debtors necessarily prolongs the depression, end quote. Railroads should not be hampered from going into the, quote, inevitable curative process of bankruptcy. In the meantime, Eugene Meyer was promoting more inflationary damage as governor of the Federal Reserve. Meyer managed to persuade both Hoover and Virginia conservative Carter Glass, leading Democrat on the Senate Banking Committee, to push through the Glass-Steagall Act at the end of February, which allowed the Fed to use U.S. government securities in addition to gold as collateral for Federal Reserve notes, which were, of course, still redeemable in gold. This act enabled the Federal Reserve to greatly expand credit and to lower interest rates. The Fed promptly went into an enormous binge of buying government securities, unprecedented at the time. The Fed purchased $1.1 billion of government securities from the end of February to the end of July, raising its holdings to $1.8 billion. Part of the reason for these vast open market operations was to help finance the then huge federal deficit of $3 billion during fiscal year 1932. Thus, we see the grave error of the familiar Milton Friedman monetarist myth that the Federal Reserve either deliberately contracted the money supply after 1931 or at least passively allowed such contraction. The Fed, under Meyer, did its mightiest to inflate the money supply, yet despite its efforts, total bank reserves only rose by $212 million, while the total money supply fell by $3 billion. How could this be? The answer to the mystery is that the inflationary policies of Hoover and Meyer proved to be counterproductive. American citizens lost confidence in the banks and demanded cash, Federal Reserve notes, for their deposits, currency in circulation rising by 122 million by the end of July, while foreigners lost confidence in the dollar and demanded gold, the gold stock in the United States falling by $380 million in this period. In addition, the banks, for the first time, did not fully lend out their new reserves and accumulated excess reserves, these excess reserves rising to 10% of total reserves by mid-year. A common explanation claims that business, during a depression, lowered its demand for loans so that pumping new reserves into banks was only, quote, pushing on a string. But this popular view overlooks the fact that banks can always use their excess reserves to buy existing securities. They don't have to wait for new loan requests. Why didn't they do so? Because the banks were whipsawed between two forces. On the one hand, bank failures had increased dramatically during the Depression, whereas during the 1920s, in a typical year 700 banks failed, with deposits totaling $170 million. Since the Depression struck, 17,000 banks had been failing per year, with a total of $1.08 billion in deposits. This increase in bank failures could give any bank pause, especially since all the banks knew in their hearts that, as fractional reserve banks, none of them could withstand determined and massive runs upon them by their depositors. Second, just at a time when bank loans were becoming risky, the cheap money policy of the Fed had driven down interest returns from bank loans, thus weakening banks' incentive to bear risk. Hence, the piling up of excess reserves. The more that Hoover and the Fed tried to inflate, the more worried the market and the public became about the dollar, the more gold flowed out of the banks, and the more deposits were redeemed for cash. Professor Seymour Harris, writing at the time and years before he became one of America's leading Keynesians, concluded perceptively that the hard money critics of the Hoover administration might have been right, and that it might be that the Fed's heavy open market purchases of government securities from 1930 to 1932, quote, retarded the process of liquidation and reduction of costs, and therefore have accentuated the Depression, end quote. Herbert Hoover, of course, reacted quite differently to the abject failure of his inflationist program. Instead of blaming himself, he blamed the banks and the public. The banks were to blame by piling up excess reserves instead of making dangerous loans. By late May, Hoover was, quote, disturbed at the apparent lack of cooperation of the commercial banks of the country in the credit expansion drive, end quote. Eugene Meyer's successor at the RFC, former Ohio Democratic Senator Alty Pomeroy, denounced the laggard banks bitterly. Quote, I measure my words. The bank that is 75% liquid or more and refuses to make loans when proper security is offered, under present circumstances, is a parasite on the community. End quote. Hoover also went to the length of getting Treasury Secretary Ogden Mills to organize bankers and businessmen to lend or borrow the surplus credit piled up in the banks. Mills established a committee in New York City on May 19th, headed by Owen D. Young, chairman of the board of Morgan's General Electric Corporation, and the Young Committee tried to organize a cartel to support bond prices, but the committee, despite its distinguished personnel, failed dismally to form a cartel that could defeat market forces. The idea died quickly. Not content with denouncing the banks, President Hoover also railed against the public for cashing in bank deposits for cash or gold. Stung by the public's redeeming $800 million of bank deposits for cash during 1931, Hoover organized a hue and cry against, quote, traitorous hoarding. On February 3, 1932, Hoover established a new Citizens Reconstruction Organization, or CRO, headed by Colonel Frank Knox of Chicago. The cry went up from the CRO that the hoarder is unpatriotic because he restricts and destroys credit. That is, by trying to redeem their own property and by trying to get banks to redeem their false and misleading promises, the hoarders were exposing the unsound nature of the bank credit system. On February 6th, top-level anti-hoarding patriots met to coordinate the drive. They included General Charles Dawes, Eugene Meyer, Secretary of Commerce Robert P. Lamont, and Treasury Secretary Ogden Mills. A month later, Hoover delivered a public address on the evils of hoarding. Quote, the battlefront today is against the hoarding of currency, end quote, which prevents money from going into active circulation and thereby lifting us out of the Depression. President Hoover later took credit for this propaganda drive putting a check on hoarding, and it is true that cash in circulation reached a peak of $5.44 billion in July 1932, not rising above that until the culminating bank crisis in February 1933. But if true, so much the worse, for that means that bank liquidation was postponed for a year until the final banking crisis of 1933. The New Deal. Going off gold. The international monetary system that the House of Morgan helped Great Britain cobble together in 1925 lay in ruins when Britain hastily abandoned the gold exchange standard in late September 1931. The Morgans tried desperately to keep Britain on gold in 1931, and afterward tried to get their bearings in the newly chaotic monetary arena. By the time of Roosevelt's accession to power in the spring of 1933, the Morgans had thrown in the towel on the American gold coin standard. Indeed, the Morgan-oriented leadership at the Treasury, Mills and Ballantine, had been agitating for going off gold considerably earlier. But the overriding Morgan concern was always their associates and colleagues in England, and they hoped for a rapid return to some kind of fixed exchange rate relation to Britain, and perhaps, by extension, to the other major European currencies as well. The Morgans wanted to reconstruct a regime of monetary internationalism as soon as possible. But for the first time since the turn of the century, the Morgans were no longer dominant over the monetary thinking of American financial and business elites. In the midst of the cauldron of depression, a new economic and monetary nationalism, a desire for domestic inflation untrammeled by international monetary responsibilities, began to take hold. Backed by proto-monetarist and proto-Keynesian economists eager to spur inflationist federal policies to cure the Depression, the shift of business groups toward inflation centered in farm and agribusiness groups, which had been agitating for higher farm prices since the early 1920s, and in industrialists making products for the retail market who wanted government to pour new money into consumption spending. Thus, in January 1933, powerful business groups formed the Committee for the Nation, more formally, the Committee for the Nation to Rebuild Prices and Purchasing Power, dedicated to getting the government to, quote, reflate prices back up to 1929 levels, and to get off the gold standard so that the government could issue fiat paper money for that purpose. The co-defenders of the Committee for the Nation were Vincent Bendix, head of Bendix Aviation, and General Robert E. Wood, head of the mighty retail combine of Sears, Roebuck. Others who soon joined them were Frank A. Vanderlip, former president of the National City Bank of New York, the flagship bank in the Rockefeller orbit, James H. Rand, Jr., president of Remington Rand Company, manufacturer of typewriters and other retail products, Lessing Rosenwald, major owner of Sears, Roebuck, Samuel S. Fells, producer of Fells Naphtha, Philip K. Wrigley, head of William J. Wrigley Company, E. L. Cord of the Cord Automobile Company, William J. McAviney, president of Hudson Motor Company, R. F. Wurlitzer, producer of Wurlitzer Musical Instruments, Frederick H. Frazier, chairman of the board of the General Baking Company, and a galaxy of farm leaders, Fred H. Sixauer, president of the Dairymen's League Cooperative Association, Edward A. O'Neill, head of the American Farm Bureau Federation, and Louis J. Tabor, head of the National Grange. It should also be noted that Rockefeller's petroleum products were of course goods largely sold at retail. Another emboldened inflationist group was the silver mining interests, centered in the Mountain States, which seemingly had lost out permanently to the McKinley and Republican gold forces in the 1890s. Mountain State senators led the silver bloc in Congress, and Senator Burton K. Wheeler, Democrat from Montana, introduced the bimetallic bill to reinstitute the silver-gold standard at the old 19th century ratio of 16-1. Leading theoretician and lobbyist for the silver bloc was New York banker René Leon, who got himself appointed as advisor to the House Ways and Means Committee in unsuccessfully pressing for an international conference to raise silver prices. More generally, the Rockefeller and Harriman forces had been allied against the Morgans since the turn of the century, and now they and other rising financial groups banded together avidly to overthrow and dethrone the financial and political dominance achieved by the House of Morgan during the Republican decade of the 1920s. Again, influential in the new Democratic regime was the veteran speculator and political manipulator Bernard Baruch, who had been czar of the collectivized economy as head of the War Industries Board in World War I, and who yearned to reestablish a similar, collectivist, cartelized regime in peacetime, using the Depression as the means for achieving this goal. Baruch, since childhood, had been a protege of the powerful Guggenheim family, who controlled the American copper industry, but who liked to keep a low political profile and operate through Baruch and his network of operatives. Newer Jewish Wall Street investment banking houses, more anti-Morgan than Kuhn-Leb, were also rising to help challenge Morgan, notably Goldman Sachs and Lehman Brothers, the Lehman family contributing New Deal governor of New York, Herbert H. Lehman, to the American political scene. Furthermore, Jewish retail interests, led by the Boston Filene brothers, were in favor of more inflation and consumer spending, and longtime Filene and retailer attorney Louis D. Brandeis had become powerful in the Democratic Party, and was helping run the New Deal surreptitiously from his seat on the U.S. Supreme Court. Brandeis was a longtime enemy of the Morgans, as attorney for opposing corporate interests, and a dedicated supporter of retail cartels supported by the government. Moreover, all these financial and industrial groups were swinging notably leftward, not simply in monetary matters, but also in advocating far more government intervention, including promotion of labor unions, than the Morgans were willing to accept. Thus, these anti-Morgan groups, now gathered in the Democratic Party, were happy to form a coalition with left-wing intellectuals, technocrats, economists, and social workers who wished to staff the planning agencies, all to advance their common New Deal and ultra-statist agenda. Particularly powerful in the New Deal and in the Democratic Party was the underrated W. Averell Harriman, scion of the great Harriman interests and longtime enemy of the Morgans. Harriman dominated a highly influential new agency set up in the New Deal, the Business Advisory Council, or BAC, of the Department of Commerce, which transmitted the influence of the pro-New Deal wing of industry and finance. Also dominant in the BAC was Sidney J. Weinberg of Goldman Sachs. The Franklin Roosevelt, High Park, Democrat wing of the Roosevelt family had always been close to their Hudson Valley neighbors, the Astors and the Harrimans, whereas the Oyster Bay, Theodore Roosevelt, Republican wing of the family had always been close to the Morgans. To return to monetary policy, Eugene Meyer, who, after all, had 3 years to go in a 10-year term as governor of the Federal Reserve Board, refused President Hoover's request to resign immediately upon the inauguration of President Roosevelt. But Meyer found out quickly that he could not agree to going off the gold standard and an inflationary higher gold price, and he tendered his resignation as Fed chief in early May 1933. President Roosevelt's early monetary appointments set an important signal of his new orientation and policies. To succeed Meyer, Roosevelt appointed his friend, the young Georgia banker Eugene R. Black, who had been governor of the Federal Reserve Bank of Atlanta. Black's orientation may be gauged by the fact that, when he left the Fed a year later, he was to spend 16 years climbing up the executive ladder at the powerful Chase National Bank, which by this time had shifted firmly from the Morgan to the Rockefeller camp. Indeed, for the rest of his working life, Eugene Black was to serve at Chase as protege of none other than the eminent Winthrop W. Aldrich, chairman of the board at Chase and a close kinsman of the Rockefeller family. Roosevelt's first Secretary of the Treasury was William H. Wooden, who received the appointment after it was turned down by Melvin Traylor, president of the First National Bank of Chicago, one of the main commercial banks in the Rockefeller orbit. Wooden had spent most of his career as a high official of the American Car and Foundry Company in New York, and was now chairman of the board of the American Locomotive Company. Wooden was also a director of such important enterprises as the Harriman-controlled American Ship and Commerce Corporation, as well as the Rockefeller-dominated Remington Arms Company. He had also been a founding director of the County Trust Company of New York, along with the influential Vincent Astor and Herbert H. Lehman. Wooden's financial associations in New York were therefore in the Harriman, Astor, Lehman, Rockefeller ambit rather than in the Morgan network. Ill health forced Wooden to resign in December 1933, however, and his place was taken by Henry Morgenthau, Jr., who was to be an important and controversial Treasury Secretary for the remainder of Roosevelt's reign in office. Morgenthau, who rose from undersecretary, was a longtime friend and neighbor of Roosevelt's, and a gentleman farmer interested in agriculture. He was backed by his wealthy father, who had been ambassador to Turkey under Wilson, but more important was Henry Jr.'s close links to the powerful investment banking family of Lehman Brothers. Indeed, Henry Jr. was married to a Lehman. Her mother was a sister of Herbert H. and Arthur Lehman, and Henry's nephew, Jules Erich, had married a sister of Philip Lehman. Moreover, Henry Sr. had long been a major stockholder of the Underwood Typewriter Company, and several of his fellow board members were Philip Lehman, Philip's cousin Arthur Lehman, Morris Wertheim, who had married Henry Jr.'s sister, Alma, and Waddell Catchings, a top official of Goldman Sachs. Two fateful monetary steps were taken in 1933 by the incoming Roosevelt administration. The first and most revolutionary deed, accomplished in April, was to go off the gold standard, to confiscate almost all the gold of American citizens and place it under the ownership of the Federal Reserve, to embargo the export of gold, and to devalue the dollar to $35 a gold ounce. This swift policy carried out almost completely the program of the Committee for the Nation. But in March and April, even the Morgans had been convinced by the banking crisis to go off gold. Democratic Morgan partner Russell Leffingwell was influential in urging Roosevelt to go off gold and devalue the dollar, and Jack Morgan himself applauded Roosevelt's decision to inflate and go off gold. The major theoretician of the inflationists, who had liquidated the assets of his own prior stable money association into the Committee for the Nation, was Yale professor Irving Fisher, the intellectual forerunner of Milton Friedman, who has hailed Fisher as, quote, the greatest economist of the 20th century, and who mechanistically had believed that since the price level was not rising in the 1920s, there was no inflation to worry about and no coming crash. Fisher strongly urged the inflationist devaluation and fiat standard upon Roosevelt, who had asked him for advice. When Roosevelt cast the die against gold, Fisher exulted to his wife, quote, now I am sure, as far as we ever can be sure of anything, that we are going to snap out of this depression fast. I am now one of the happiest men in the world. End quote. Fisher had a personal as well as an ideological stake in rapid inflation. Sure of a permanent prosperity and stock boom in the late 1920s, he had invested all of his wife's and most of his sister-in-law's substantial Hazard family fortune in the stock market, and he was desperately anxious for Roosevelt to reflate and drive up stock prices. As Fisher added in the same letter to his wife, quote, "I mean that if FDR had followed Glass, who had urged him to stay on gold, we would have been pretty surely ruined." End quote. As it happened, the fiat money policy did not restore the stock market, and Fisher's and his wife's and sister-in-law's fortune was ruined by his unwise speculations, a mute testimony to the unsoundness of Fisher and monetarism in explaining or counteracting business cycles. On the other side of the gold standard decision were the bulk of the nation's economists, who signed a mass petition urging immediate return to gold. They were led by two doughty, hard-money men, Dr. H. Parker Willis, who had staunchly opposed the strong Morgan inflationism of the 1920s and urged rapid liquidation of unsound assets to promote recovery, and Dr. Benjamin M. Anderson, longtime hard-money economist of Chase National Bank, who had influenced Chase President Albert Wiggin in favor of hard money and laissez-faire policies. In the executive branch, the major opponent of the new fiat regime was Lewis W. Douglas, Arizona scion of the Phelps Dodge copper mining interests, and Roosevelt's head of the Bureau of Budget. The fiscally conservative Douglas had, in early 1933, persuaded Roosevelt to make severe cuts in the proposed appropriations of the executive agencies. Even though monetary nationalism had triumphed, the Morgan interests and the other monetary internationalists were anxious to reestablish fixed exchange rates with Britain and to rebuild the special relationship with Morgan allies in Britain and Western Europe. The ultra-inflationists, led by the Committee for the Nation, were strongly opposed to fixed exchange rates with Britain and wanted to press ahead with monetary or dollar nationalism, higher gold prices, and continued inflation. Tensions within the administration and within the industrial and financial communities centered around the World Economic Conference set for London in June 1933, which had been prepared for a year by the British-dominated League of Nations, in a desperate attempt to restore some sort of fixed exchange rate, stabilized international monetary system. The World Economic Conference, with delegates from 64 nations, met on June 12th. The gold bloc at the conference, led by the French, urged an immediate restoration of the full classical gold standard. The British wanted fixed exchange rates, tied to gold or not, but emphasizing that the pound must be cheaper at $4, so as not to lose the export advantage Britain had built up in the past 2 years. The United States, on the other hand, wanted to place prime emphasis on continued domestic inflation. Currency stabilization, which should not put the pound below $4.25, could wait until some future date after domestic prices had risen. From the beginning, however, there was great tension between the bulk of the American delegation to London and the Roosevelt administration in Washington. Chief economic advisor to the American delegation was James P. Warburg of Kuhn-Leb, who took the Morgan line of favoring a new international gold standard at new and more realistic exchange rates. Morgan oriented George L. Harrison of the New York Fed and Professor O.M.W. Sprague were sent by FDR to work on an agreement for temporary stabilization of exchange rates for the duration of the conference. When, however, Sprague and Harrison concluded an agreement on June 16th with the British and French for temporary stabilization of the three currencies, setting the dollar sterling rate at $4 a pound and pledging the United States not to inflate the currency in the meanwhile, Roosevelt angrily rejected the agreement. Roosevelt gave two reasons to the chagrined Sprague and Harrison. The pound must be no cheaper than $4.25, and Roosevelt could accept no restraint on his freedom to inflate to raise domestic prices. Harrison quit in disgust and returned home, a harbinger of the fate of the Morgans in the years to come. The World Economic Conference proceeded with lengthy discussions, both the Americans and British talking about an eventual, quote, gold standard, which would enjoy no domestic gold coin or bullion circulation, with gold to be used only as a medium for settling international balances of payments, a foretaste of the eventual Bretton Woods system after World War II. The stubbornness of the United States finally forced the assembled delegates to agree on an innocuous final declaration at the end of June that committed the United States to very little more than its own resolution for eventual return to a sadly denatured gold standard, coupled with a vague agreement to cooperate in limiting exchange rate speculation. This declaration, weak as it was, seemed to offer hope of eventual stabilization, and so it was strongly supported by Sprague, Warburg, and by Chief Brain Truster Raymond Moley, Assistant Secretary of State, who was head of the American delegation to London. Within the administration, the agreement was strongly supported by Douglas, Baruch, and by Undersecretary of the Treasury Dean G. Acheson. Acheson was a disciple of Morgan-oriented lawyer Henry L. Stimson, and one of his Washington law partners, J. Harry Covington, was a director of the Guggenheim-controlled Kennecott Copper Corporation. Sending the proposed declaration to Roosevelt on June 30th, Moley pointed out that dollar depreciation during June had brought the pound-dollar rate up to $4.40, well above the $4.25 that Roosevelt had insisted on. On July 1st, however, FDR stunned Moley, the delegates, and the American supporters of the agreement by flatly rejecting the declaration, stating that the United States should be allowed the time, quote, to permit a demonstration of the value of price-lifting efforts which we have well in hand, end quote. But, adding insult to injury, Roosevelt followed up this rejection on July 3rd with an arrogant and contemptuous message to the London Conference, which became known as his famous, quote, bombshell message. Here, Roosevelt denounced any idea of currency stabilization as a, quote, specious fallacy. In particular, he thundered, quote, old fetishes of so-called international bankers are being replaced by efforts to plan national currencies, end quote, in order to obtain a fixed price level. In short, Roosevelt now totally and publicly committed to the entire nationalist, Fisher, Committee for the Nation program for fiat paper money, currency inflation, and a very steep, quote, reflation of prices. The idea of stable exchange rates or an international monetary order would fade away for the remainder of the 1930s, and monetary nationalism, currency blocks, and economic warfare would be the order of the day for the remainder of the decade. The chagrined supporters of the aborted London Monetary Agreement soon found it necessary to leave the Roosevelt administration. This included Acheson, Warburg, who had been offered the job of Undersecretary of the Treasury before Acheson, and who was close to his ancient Kuhn-Leb allies, the Harriman interests, Lewis W. Douglas, who was soon to write a bitter book attacking the New Deal, and Moley, who returned to the Academy and who helped run Today and Newsweek with his friends the Astors and the Harrimans. The Committee for the Nation has long been known as the prime mover behind the fiat money and inflationist policy of the early New Deal. What has not been known until recently was the powerful, behind-the-scenes role in the committee played by the Rockefeller Empire, in conjunction with their longtime international rival, the British Royal Dutch Shell Oil, financed by the Rothschild interests. Thus, a top financier of the Committee for the Nation was James A. Moffett, a longtime director and high official of the Rockefeller flagship company, the Standard Oil Company of New Jersey. Moffett, friend and early supporter of Roosevelt, coordinated his behind-the-scenes agitation for inflation and against the London Economic Conference with New York banker and leading silver bloc agitator René Léon, who functioned as an agent for the powerful Sir Henry Dieterding, head of Royal Dutch Shell, who was heading the international agitation for a worldwide, cartelized increase in the price of silver. Dieterding pressured Roosevelt for inflation, not so much in his capacity as an oil leader, as in a financier of silver production. It turns out that Moffett and Léon, working in tandem, were most influential in successfully pressuring Roosevelt to torpedo the London Economic Conference. Here was a startlingly clear case of Rockefeller and Royal Dutch Shell against Morgan.